This increase in the dollar's value doesn't look like it's going to reverse anytime soon.
Think about a world where the once unstoppable US dollar is losing its grip on the global stage, and waking up tomorrow to find your savings worth half their value.
Nuclear option, that is, selling US treasuries, US bonds.
The move in the dollar index falling sharply today and down more than 2% in a week.
Trillions of dollars were wiped off the US stock market in a matter of days. It was the sharpest downturn since the pandemic.
Now $4 trillion in market value from the S&P 500.
The S&P 500 had its biggest one-day drop.
The chance of recession is higher than most people believe.
In early 2025, the US dollar index hit a 3-year low, dropping 1.83% in a single day to 101.02. Its worst performance since 2022. Year to date, it's down over 4%, marking the sharpest decline since the 2008 financial crisis. The US dollar, once the undisputed king of global currencies, is now in freefall. Is this the beginning of the end for the greenback, or just a storm before the calm? Before you move on, if you haven't subscribed yet, please subscribe to 10-Minute Quest. In the months following Donald Trump's re-election, global markets experienced an unusual combination of US interest rates and the US dollar falling in tandem. This was due to the fact that US Treasury yields spiked to multi-decade highs, while the US dollar plummeted to multi-year lows. This breakdown of the traditional correlation between yields and the dollar sent a clear signal that confidence in American economic leadership had been deeply shaken. The interest rate on the 10-year US Treasury jumped by an extraordinary 0.5 percentage point in just a week, and bond prices plunged as investors worldwide dumped what was once seen as the safest asset on Earth. Instead of strengthening on those rising rates, the US dollar dropped roughly 3% against other major currencies in that same week, a decline rarely seen outside of major crises. The dollar sank to its lowest level in years against the euro and to a decade low against the Swiss franc. Global investors parked their money in US dollars and bonds as classic safe havens. But after Trump's return, the US bonds and the dollar began behaving like risky assets. The culprit behind this confidence shock was not a mystery. It lay in the policy upheavals emanating from Washington President Trump. Just days after his inauguration, Trump announced a sweeping set of import tariffs so broad and abrupt that markets worldwide were caught off guard. He dubbed it Liberation Day, a move to free America from trade imbalances. Economists warned of slower growth and higher prices, with reports showing consumer sentiment in the United States nosediving and inflation expectations climbing. Americans feared that tariffs on everyday goods would drive up costs, and investors demanded extra compensation to brave the uncertainty of the United States. Trump's economic and foreign policy approach caused instability by restricting allies from defense spending and trade deficits, withdrawing from international agreements, and suggesting a weaker US dollar. This led to allies questioning the reliability of American consistency and considering alternative financial plans. Trump's unorthodox style disrupted predictability, leading to unpredictable tariffs and exemptions, causing markets to swoon. Trump partially backtracked, temporarily pausing new tariffs on many countries but not on China, leaving investors dizzy and distrustful, creating an unnecessary crisis and undermining global confidence in America. As faith in U.S. policy stability eroded, global investors sought safety, and gold, a timeless refuge in uncertain times, surged to record highs above $3,200 an ounce. For those who still held U.S. assets, many rushed to hedge their bets, buying insurance in the currency markets to protect against a falling dollar. This led to a self-reinforcing cycle, with falling confidence leading to a falling dollar, which sapped confidence. The slump in stocks, bonds, and the dollar was a significant concern for Wall Street, as the U.S. had traditionally been a top global capital destination. International clients were questioning political risk in the U.S., leading hedge funds to reduce exposure to U.S. assets. Investors began diversifying their portfolios, some increasing stakes in European equities, and others looking to emerging markets in Asia and China. Safe haven flows into currencies like the yen and franc suggested that some money was waiting on the sidelines until the outlook for U.S. policy settled. The U.S. Treasury's stance on bonds as a safe investment has influenced global investor behavior, increasing the risk premium on U.S. bonds. The weakening dollar has led to increased import costs, inflation pressures, and tariffs, causing instability in investor sentiment and a feedback loop of uncertainty. This has impacted everyday Americans' purchasing decisions. Under the Trump administration's go-it-alone approach, reassurance was hard to come by. The most far-reaching consequence of this period has been the acceleration of de-dollarization, a global push to reduce reliance on the U.S. dollar. For over 75 years, the dollar has sat at the top of the financial world, serving as the main currency for international trade and the chief reserve asset for central banks. However, the turmoil of Trump's second term has led many nations to wonder if that privilege has been stretched too far and whether they would be safer taking the dollar down a peg in their own economies. China has dramatically expanded the international reach of its currency, the yuan, by launching a new digital yuan payment network, linking up with dozens of other countries across Asia, the Middle East, and Africa. By 2025, the urgency and scope of these efforts had changed, prompting a flurry of moves aimed at bypassing the dollar-centric system. Brazil has set up direct currency exchanges with China for trade. India has started buying Russian oil in rupees instead of dollars. And France has carried out its first LNG gas sale to China denominated in yuan. Traditional pillars of the dollar-based oil trade have shown openness to pricing deals in currencies like the US, Saudi Arabia, and South Africa. De-dollarization captures all these trends, aiming to diversify away from the dollar in international reserves and transactions. Global central banks have gradually been trimming the share of dollars in their foreign currency reserves, down to around 59% from roughly 70% at the start of the century. The US dollar has experienced a decline in its global presence, with the euro and smaller currencies like the Canadian and Australian dollars, as well as the Chinese yuan. Central banks have also been buying gold, an ultra-safe asset that is not controlled by any one country. This shift into gold has accelerated after geopolitical shocks and has been reinforced by Trump's trade battles. The US dollar remains the cornerstone for the time being, but it has changed the sense of inevitability for many countries. They are now actively preparing for a more multipolar currency world. One European central banker warned that actions like Trump's tariffs and sanctions could undermine the system that gives the US its influence in Washington. Some of Trump's advisors have an adversarial view of the dollar's global role, viewing it as an arrangement that allows other nations to freeload on the US, by forcing other countries to pay for that privilege through favorable trade deals or aligning with US policies. The administration has essentially weaponized the dollar, but in doing so, it may be accelerating the weapon's obsolescence. Countries confronted by Trump's ultimatums are more eager than ever to create alternative channels outside American control, such as new trading blocs, digital currencies, or barter systems. This is a classic case of blowback pushing too hard and the world pushing back as an unintended result of Trump's second-term policies. The fall of the US dollar in 2025 is about more than a currency. It is about trust. The dollar's strength has always been underpinned by the world's trust in the United States, its economic stability, political institutions, and the predictability of its policies. Return of Trump's. Trust was put to the test as never before, with his foreign economic and trade decisions rattling the confidence of investors and nations for the first time in generations. The key for the United States now will be whether it can rebuild that confidence or whether this period marks the beginning of a more fundamental changing of the guard in the world economy. The lesson learned from the dollar slide in 2025 is that a world losing some faith in the steadiness of U.S. leadership and taking concrete steps to protect itself from American uncertainty will not be easily forgotten. Ironically, a president who promised to put America first may have set in motion forces that make the global financial system less centered on America than it has been in a long time. The greenback's sudden slide raises critical questions about America's economic and geopolitical trajectory. Whether this is a temporary wobble or the start of a longer-term decline hinges on trade policy, Fed decisions, and global confidence in U.S. leadership. For now, staying informed and nimble is paramount. If you found this breakdown valuable, smash that like button, subscribe for more real-time market analysis, and drop a comment. What's your dollar hedging strategy?